Hi everyone, wanted to do a really quick video of the 5 different types of accounts we have in accounting. You'll get very familiar with this, so this is for our beginners with absolutely no accounting knowledge. It's just really rough video so you can kind of get an idea of everything. So we have assets, liabilities, revenue, expenses and equity. Now you'll notice in your next coming weeks, from I think weeks 2 to about 5, you'll start to integrate how to prepare a income statement, which is our profit and loss statement, or a balance sheet, which is also a statement of financial position. So all of a sudden you can already hear that we're interchanging different words within my accounting speak. So you will get used to it as we go on, but I try and keep it very simple. I'll try and always refer it to your profit and loss statement or our balance sheet. So our profit and loss statement includes 2 of the 5 accounts, so which is our revenue and expenses. So basically we're looking at how much money did the business make. So it's our money coming in minus our money coming out. So the profit we want to see. Well, hopefully, sometimes if our expenses are greater than our revenue, then it's going to be a loss for a business. And then we have our balance sheet, which is our assets, liabilities and equity. Now you're going to get very familiar with the equation. Assets equals liability plus equity. We'll get into that later as to why that makes sense. But basically what our balance sheet is doing is it's showing the company's financial position. So we want to know how many assets and how much debt we have, and then kind of the equity is the value in between. So I want to give you some examples of every single segment because it's important to understand how every account plays into it and what all my words mean, because you're going to get very used to it and it's important that you understand the terminology at the very beginning. So let's start over with our P&L, so our profit and loss statement. You'll probably notice when I start typing, I'll say P&L for profit and loss. So P&L, as I said, we're going to have, you'll see that it consists of our revenue less cost of goods sold, less expense, or will equal gross profit, less expenses equals our net profit or loss. So revenue is money coming in the door. So if I have a pawpaw ointment company, it's however much I make selling these little things. Okay, so that's our revenue. And when I say cost of goods sold, that's an expense, but it's expense directly related into making this pawpaw ointment. What's included in there? The cost. So let's say our revenue is $8, so our sales price is $8. We sell that, but it costs us $4 to make. So that's our cost of goods sold, $4. So that means our gross profit there is $4. 8 minus 4 equals 4. Now, when we sell a product like this, we're going to incur other expenses, not just the product. We're going to incur advertising. What about paying my wages to sell this product? So there's heaps of other expenses, computing, software, internet, all that sort of stuff. So all those expenses we have to pay is called an expense. So we include that in our P&L. So our P&L is looking at basically money coming in and money coming out, and what's the company's net position. So if you look at your day-to-day life and you apply it to yourself personally, it's looking at basically salary coming in and expenses going out that it costs you to live month to month. But we're applying this on a corporate level, on a business level. So revenue, money coming in, what we make, expenses, money going out, and then we classify that in what they are. So if you have an expense for your telephone, which is over there somewhere, that's going to be called telephone expense. If you have an expense to make the product, as I said, because this is what we're selling, this is our cost of goods sold. And so you'll see later on how to actually calculate that formula. I won't go into it this video. But I just want you to understand the terminology that I'm using. So when I say revenue, the money coming in the door, it can also be income too. So revenue, income, same thing. Just usually we will use revenue. Expenses can have wages expense, telephone, office equipment expense, so many, electricity. I can keep going, but in our P&L you'd actually list all that out. Then we go into our balance sheet. So this is when we've got our assets, our liability, and our equity. So our assets is when we own something of value. So let me get my keys. Okay, so this is getting me into this apartment. So this apartment, if I did own it, this would be my asset. Okay, so assets are anything that is of value and it's kind of tangible. So you'll be looking at other assets that you can have, which is furniture. You'll probably see plant and equipment, which is maybe if you're on a farm and you've got a machine that you need to ride around, so that's an asset. So it's anything that you buy and then you can dispose of and it would be of value. So what I mean by that is if you have a car, you buy it, that's an asset because when you dispose of it, you're going to get money back from it. So it's of value. And then we have liabilities. So that's your debt portion. So again, as I said, I've got my keys, and if I owned it, I'd have a mortgage. That mortgage portion, that is our debt, that's our liability. So we need to include that into our balance sheet. So as I said, our balance sheet has our assets, our liabilities, and our equity. And our equity portion is basically the difference between that. It's the value we have in the company. So what you will see throughout this unit in terms of your assessment is you'll have two forms of equity. One is our retained earnings amount, which is the profit you'll get from your P&L, which is our revenue minus expenses. You'll see how this integrates, but I just want to get you used to the terminology. So in our equity section in the worksheet, we'll have our capital section, and then we will have our retained earnings. So I'm talking about retained earnings first, and this is our profit or loss we're carrying into. So we need to carry that over into our years, so that's why it's included in equity. Now our capital portion. So when I'm an owner and I have an investment, I'm going to put an initial investment into a business. That's called capital investment. So I'm an owner, I'm putting money into the business. If I do director drawings, because I'm the director of the company, I take out $5,000. That's a reduction in equity in our capital section. It's money coming out. Okay, so there are our 5 accounts. We've gone over revenue, expenses, assets, liabilities, and equity. They're 5. There's no more. That's all you'll have. You'll get very used to it. Week 2, we introduce the worksheet, then we start on our P&L, and then we start on our balance sheet. So it's really important that you understand every single transaction and how it works in a worksheet. If you don't, ask me. Then that worksheet, you will see, trust me, if it sounds confusing now, you will see how it integrates into our P&L and then into our balance sheet. We've got a really good collab coming up that will cover this off. But any questions, post below, and hopefully this helps a little bit. So last thing I want to touch on is accounts receivable and accounts payable. So accounts receivable is an asset and accounts payable is a liability. Why is that? Accounts receivable. So accounts receivable is something where we're going to receive money in the future, just not right now. So we know we're going to get a benefit in the future. So that's an asset, so that's something of value. And then accounts payable is something when we have to pay it in the future. So that's bad. Paying something in the future is not great. So that's a liability. So think back to like a mortgage. It's something we pay every month to pay off a debt. So accounts payable, something we're paying off in the future, which is a negative, thus it's a liability. So that's the differentiation between the two. So I myself in a company, if I am going to receive something into the future, that means it's accounts receivable. If I'm going to pay something out in the future, it's accounts payable. So that's the difference between those two. We'll get into detail about how you enter those into your worksheets very soon. But it's really important to be able to distinguish the two. It will always reference either accounts payable or accounts receivable. You just need to understand what the differences are between those two things. So for example, you might have customer purchase goods on credit. Very typical thing you'll see. So when you hear the term credit, that will mean that they're not paying cash straight away. They're putting it on their credit card, on lay-by, afterpay, whatever it may be. So that means, okay, it's a customer. That means we know that we're going to get money. But because it's on credit, we're going to get the money in the future. So as I said before, accounts payable is when we're going to get a benefit in the future. So that means when a customer buys something on credit, that means it's accounts receivable. It's a benefit we're going to get in the future, and that's an asset. But let's flip it around. If it was I myself as a company am buying a desk on credit. So I'm going to buy something, I'm not going to pay for it right now, I'm going to take the desk with me and I'll pay for that later on my credit card. Accounts payable, because I'm paying for a debt in the future, and so that's not good. That's well, not good, it's cash management, but that's a liability that I have to pay in the future. It's debt that's coming for me in the future, so that's a liability. So it's important to distinguish those two. You will have to know how to enter them into the timed worksheet, but this is just getting you used to the terminology. So whenever you have a business transaction that talks about credit in it, that means you can always be assured to know that it's in relation to accounts payable or accounts receivable. You just need to figure out which one it is. Again, if I said that it's something, a benefit we're receiving, it's accounts receivable. If it's a payment we're going to make in the future, it's accounts payable, accounts receivable, asset, accounts payable, liability. Basic terms I've covered off. You'll probably notice that we interchange quite a lot, which is something you'll get used to in accounting. I'm very mindful of a lot of people here with no accounting experience, so more than happy to assist you as best as I can. But again, practice makes perfect. Keep doing lots of questions, reading information, and asking me questions, and we'll get there all in the end. Thank you.